Uh, Welcome to the State of PropTech and Venture Capital Industry virtual event. My name is Faisal Hadi. I'm a Senior Vice President at JLL Consulting, based in New York. So before we begin, I just wanted to extend my gratitude to the following groups. The first is the Berman Group. Thank you for all your hard work in coordinating this event today and answering my 101 questions. Second is our CoreNet sponsors, which you saw earlier. Without their continuous support, we really can't put these events together. So they're really responsible for bringing us all together and talking about these amazing topics. Thirdly, the New York PropTech Committee, especially Brigitte and Dan, for being awesome chairs and leaders. And thanks to all of you for attending today. And finally, a big thank you to our all-women speakers today, Maureen, Sophia, and Megan, who I've had the pleasure to work with in preparing some of this content today. And thank you for being sort of my PropTech teacher and your patience over the last few weeks. So thank you for that. So before I pass over to Maureen, I want to share with you a few quick insights from my experience with clients. During the pandemic, three things are becoming quite clear. The first is this pandemic has accelerated, has acted as an accelerant to the digital transformation. And actually, McKinsey has found that the digital adoption acceleration is 7 years globally and 6 years in North America. And this is all just looking at just the last year. The second is that employees from the tenant side and landlord side will definitely have a big say and be empowered on what this sort of digital enabled future of work will look like, especially in today's really hot job market, if that sort of continues. And finally, the critical skill sets of today will be the soft skills for today and tomorrow. So, deep listening, being curious, and having that sort of continuous thirst to learn. And I think this is why, to me, this session is so important, right? So the way the speakers have structured this is really for you to learn the basics, right, of PropTech and venture capital, but also talk a little about where we are today and where this industry might go in the future. So I really hope that you find it insightful, you find it valuable, as I have. So one thing I encourage you to do is to exercise deep listening, ask questions by using the chat function in Zoom. We baked in time in the end to answer those questions. So if you think of something, just put it in and I'll bring it up at the end. And feel very, very comfortable to ask any questions that you can think of. So without further ado, over to you, Maureen, to get us going.
Thanks, Faisal. Appreciate it. Welcome, everyone. We're very excited to be here with you today to talk about the state of PropTech and the VC industry. Just going to share with you our deck for today. Okay, I think hopefully everyone can see it. Thumbs up if you can. We're going to kick off by jumping into just the quick agenda review. Well, we decided to, rather than to give you a traditional panel, which I'm hopeful that you all are as bored of as we have been, is give you something different, which is kind of really being a co-presenter, the three of us, around the topics that we've heard back from you and Faisal has shared that are most interesting to you for us to cover today around PropTech and the VC industry. We would love for you to give us questions along the way in the chat box at the bottom of the screen, as Faisal mentioned, and we'll certainly leave time at the end of this session for questions as well. So going to kick right off and do quick introductions of the three co-presenters. I'll start with myself, Maureen Waters. I'm a partner at Metaprop, a venture capital firm based in New York, focused on early stage startups, and we are the largest in the early stage space. And we'll talk more about each of the firms that we work with and for in just a few minutes, but I'll leave it there and pass off here to Megan.
Thanks, Maureen. Hey, everyone. I'm Megan Riley with the JLL Spark team based in San Francisco, although I am currently a digital nomad. I won't bore you with my background too much, but it's a mix of working for startups, working with startups, investing in startups. I also had a short stint in politics, but then with Spark for about 2 years, and excited to talk to you all today.
Hi, everyone. My name is Sophia. I'm an investor at 94 Ventures, which we'll talk about in a little bit, but my personal background is in real estate development. So I worked in development here in New York, which is where I'm based, for a few years before going to business school and kind of jumping over to the venture side. Actually started my career on the tech side at Metaprop, which is where Maureen's at, and made my way over to 94 a couple years back, and excited to talk to you all today.
Thanks, Sophia. So we'll jump right in. And the first, kind of section we have for you today is really focused in on the world of VC, venture capitalists, and what does that role look like? So we're going to start here with really kind of explaining that world, and then we'll go a little bit deeper into each of our worlds. But really, we feel that, if being a VC in today's world, with the 10,000 plus startups that we have seen today, is really a bit of bridging the gap between the real estate and tech. And, I think that you'll see here on the screen that the tech startups really are looking for venture capitalists in order to bridge that gap and get, more engaged with their customers, whether they're occupiers, investors, or specific service providers. But basically, it is our role to really provide that resource, whether it's capital or kind of strategic resources, or kind of helping them build a plan to accelerate their growth. That's really the world in which we live in each day, and helping those startups. From the standpoint of each of us individually, we are all in the VC world a little bit different. Each of us has a little bit of a different role, and I thought it'd be helpful for us to go a little bit deeper on each of our roles. I'll start with Metaprop, as mentioned earlier, early stage prop tech investor, largest in that space with 140 plus portfolio companies in our portfolio. 140 million in AUM. We have historically and today spent all of our time on pre-seed to A, which is the earliest of prop tech, startups. And so, we see 200 plus a month today, which is a pretty significant number in the real estate space. Again, we'll talk a minute about specifically how to define prop tech, but I'll pass it off here to Megan again to talk a little bit about JLL Spark.
Sweet, thanks. For those that don't know, JLL Spark is the venture arm of JLL. So we're a corporate venture capital vehicle, a CVC, some will call us. We invest in early to mid-stage startups. Our first fund is $100 million. Because we're a CVC, all of the money that we're investing is JLL's money. So it comes directly off of JLL's balance sheet. That is unique to a CVC and unique out of this group of VCs that we're talking about today. Another thing that's unique about us, and this is really unique to CVCs, but we're not just investing for return. Obviously, a return on our investment is great, but we're really looking to make an impact on JLL and our core business. That means, are we improving our service delivery model through these investments? So are these startups actually selling to JLL so that we can better serve our clients? And then in some cases, are we helping them sell directly to our clients? So we serve as a channel. Oftentimes we actually resell, and we have commercial agreements with our startups as well. And last thing I'll say is we invest for JLL Fit, and that's basically anything that touches the commercial real estate lifecycle we would invest in. So we're not specialized, and if you look at our investments, we really, it kind of runs the gamut. So Sophia, you want to take it away?
Wait, just 1 second, Megan. Could you just please describe this, what you mean by CVC, in case folks on with us don't understand the acronym?
Yeah, so it's a corporate VC, and like I said before, it's we don't have any outside investors. it's JLL. In this case, it's JLL's money. There's tons of CVCs out there, not a ton in the commercial real estate space, but in other industries there are. So no outside investors, all balance sheet capital. It's really JLL saying we are investing in the future of technology. We know we can't build everything. We know we need to partner, we need to invest. So this is our way of ensuring that we are innovating and thinking long-term for our clients. But again, no outside investors, all JLL money. That's typically what a CVC is.
Thank you.
Thanks,
Sophia.
Megan. So as I mentioned, I work at 9-4 Ventures. So obviously we're a real estate tech-focused venture fund. So what does that mean? It means we invest across the real estate life cycle. So from search and discovery to design and build to property management, all the way through sales, marketing, amenities, and everything in between. What makes us maybe a little bit different than some of the others is in our definition of prop tech, personally, we include the industries that sell to and through real estate, such as finance, insurance, maintenance, and some others. And to that end, we're actually backed by institutions that touch all of those. So to name a few, Valley Bank, State Farm Insurance, Ace Hardware. So a little bit different than JLL, who's investing off balance sheet. We take outside capital from what we call LPs or limited partners. And we were actually founded by an owner operator himself. So my partner, Jeff Elo, who's the founding partner of the fund, he's actually the CEO and founder of the Larimar Group, which is a national institutional multi-billion-dollar real estate owner operator based in Chicago. So when we are making investments, we lean on Jeff and his team at the Larimar Group a lot to help us, test a lot of technology in his properties. And he's got anything from office to multifamily to senior housing to retail and a bunch of other asset classes as well. So we're asset class agnostic and we're also stage agnostic, which is, as Maureen mentioned, Metaprop is early stage. We can kind of catch you early, middle, or even a little bit later up to Series C, which is kind of middle to late stage.
Awesome, thanks, Sophia. So hopefully, as you can see, we each have a little bit of a different role in the world, in the venture capital world. Happy again to answer, if we missed something or you have a question, please feel free to put it in the chat at the bottom of your screen. We're going to jump now into prop tech. So a little bit of just a background, because sometimes we find that folks don't have a good understanding of what prop tech is, but at the very, very basic level, it's kind of the intersection of property and technology, sometimes referred to as real estate tech, sometimes referred to as property technology, but really it's all technologies that impact the built world and the people, processes, and ecosystem that interact with it. So a little example on the right here of the ecosystem, where you'll see prop tech in the center, and everything surrounding it, from fintech to contact, which is construction tech, the smart, all of the smart tech that we're seeing today due to COVID that we're going to talk a little bit about. And then at the bottom of the screen, you'll see some notable prop tech examples, just to kind of get your contextually in the space around, these are names that you probably have seen before. So we'll jump next into the prop tech market map, which if you haven't seen, it changes daily, but it's quite of an eyesore when you try to really break it down. But I thought it was helpful to really show you that there isn't any corner of real estate today that hasn't been touched by prop tech at this point. We have approximately 10,000 startups today in the prop tech world. And you'll see here on the left side of the screen, hopefully, maybe it's a little small for you, apologies, but everything from data and analytics, which includes real estate, fintech, marketplaces, investment platforms, home buying, tech-enabled, and mortgage, which has become big in COVID, and blockchain, to flexible, space, co-working spaces, tenant experience, smart build, everything smart building, smart homes, the IoT component. construction tech, which we're going to go deep into, all of the home services that have really accelerated most recently, and then workflow management, so process management, and then augment, AR and VR, which is, the augment and the virtual reality that you see sometimes if you're looking at doing home tours virtually. But again, prop tech is the entire world of real estate, so it's both commercial and residential, and everything in between. So if we go to this next slide, you'll see the entire value chain of real estate across all of the global prop tech hubs, and then of course touching every asset type within real estate, whether it be office, retail, multifamily, and so on. So you'll see here some call outs of some of the real winners who have emerged in each of these categories, whether it be development and construction with Procure, or payment and services with Lemonade. I'm sure you've heard of Zillow, and the diligence in Compass, which is a call out on the brokerage side, and Opendoor, of course, on the financing. So it's quite a busy world as it relates to prop tech in real estate. From the standpoint of kind of just to summarize this for you before we jump into the market component, prop tech is the fastest growing segment over the last 5 years. You'll see here, if you went back to 2012 or 13, I don't think anybody even realized what prop tech was. Certainly it was, still kind of out there being considered. But today, more than ever, it's a huge generator of value. And you'll see this ends in 20, but if you were to go into 21, it will be, certainly back up and we're looking to exceed the 19 levels. But basically over 100 billion of prop tech enterprise value created through all these businesses. And then everyone within the real estate sector is leaning in and really, whether it's deploying or developing technologies or investing and co-investing with us in specific startups. So it's very busy time in the prop tech world. From what we're going to go over and jump into next is the state of prop tech, which is more around the market. Some of the key takeaways, as I just mentioned, there's record activity across the board. More capital than we know what to do with. Prop tech, the sentiment, we have a confidence index at Metaprop where we do twice a year, which tells us the sentiment of both the CEOs investing in prop tech, but also the CEOs on the startup side. It's at all-time highs. We have one coming out in just a few weeks, which is also looking even higher than the end of the year review. Prop tech sector overall has really reached a stage of maturity, which we'll talk to in a moment. From a prop tech sector, the stock performance, you'll see here, I think this is a very interesting graph to share on, it's an index that KPW actually created, and it compares, you'll see the black line at the top is a prop tech index overlaid on the NASDAQ, the S&P 500, and Russell 2000. And so you'll see here, we feel it's an interesting way to look at prop tech, but the performance as compared to broader industries is kind of just accelerated dramatically and outperformed almost all of the other indices over the last decade. The number of public companies has doubled over the last decade as well. And, now you'll see in the next page, there's an uptick also in prop tech IPOs due to this outperformance. You'll see here, the red highlighted areas are recent public, entrants into the IPO space. Notable ones that I mentioned already, as in Compass or Procure. I think SmartRent, which is in the portfolio. Sophia, maybe you could talk to us a little bit about, since it's in your portfolio.
Yeah, so SmartRent, as Maureen mentioned, is going public soon. So not yet IPO'd, but they're going public via SPAC, which I'm sure you all have heard a lot about this year, especially, or maybe last year. Just briefly touching on what a SPAC is. Stands for Special Purpose Acquisitions Company. It's essentially a shell company set up by investors with the sole purpose of raising money through an IPO to eventually acquire another company, in this case, SmartRent, and take it public. In terms of double clicking on what SmartRent actually is, SmartRent's a smart access management platform. So it connects, monitors, optimizes IoT devices for both single family and multifamily properties. So think, smart locks, smart thermostats, leak detection hardware and software, and so on. So the thought here at a high level is, in addition to creating a better, more delightful experience for tenants, SmartRent also has benefits for operators. So it allows them to monitor and protect assets, save money, create ancillary revenue. And one of, just to call out one example of how they do that is through their self-guided tour product. So this is something that came out during COVID. And this product allows potential tenants to see apartments on their own, which then enables owners to cut down on broker fees. Obviously, this was something that kind of inflected during COVID because people didn't want other people taking them around in their apartments, so they could actually go see them on their own. Sample customers here, just to call out a few recognizable names: Aimco, Greystar, Equity Residential, Lennar, and a whole host of others. Happy to answer more questions on SmartRent later on, but that's them at a high level.
And you'll find them here under the property management software category on this chart. I think we addressed the question that came into the chat around the IPO on the SPAC. Sophia went deep on that, so let us know if there's additional questions there. But you'll see here kind of the entrance. A good point to make here is they're not all IPO, but potential candidates. The two that are call outs are really around Compass and Procure on this slide. We'll move into next.
I'll add, Maureen, on the IPO side. Typically, a company has to have at least $100 million in revenue to be considered for an IPO. That's kind of conventional wisdom, but it's not always the case. And that's a traditional IPO, not necessarily a SPAC. A SPAC can take a company that's not necessarily ready to go public earlier, which is pretty cool.
Yeah,
kind of like a loophole.
Adding on to that, Megan, some people ask, like, why would a company choose SPAC versus IPO? There are a whole host of reasons, which I won't go into, but super quickly, some of the reasons for that are it's faster than a traditional IPO. So a SPAC usually takes, call it 3 to 6 months or so, usually less than 6 months, versus a traditional IPO process, which is usually about a year at the minimum, usually closer to 1.5 years or 2. It's cheaper. So with an IPO, most companies have to pay for what we call a roadshow, which is going around and pitching to investors and basically gearing up for that process, which costs a lot of money. And then access to operational expertise. So usually SPAC sponsors are industry professionals that have intimate experience with the company they're taking public. So in SmartRent's case, Fifth Wall is the acquisition partner, and Fifth Wall is a prop tech VC fund. So they have intimate experience in the space.
Thanks, Sophia and Megan. We'll jump in next to really the investment activity, which is at an all-time record pace. Funding continues to increase. Maturity in the industry here, you'll see on the bottom left, from seed to early stage and late stage, is a new trend. It's been, traditionally more on the seed to early stage side, but we're seeing now, much more advancement on the late stage. You'll see on the top left here, sort of the to the right, the 2021 activity is just off the charts and is set to be at record levels. The one call out I'll mention here, you'll see in the center all of the venture deals that have happened, or not all, I'll say some of the most notable venture deals. The one thing that's important to note is that fintech has continued to be the largest vertical of prop tech venture investment, which is about 42% in the first half of 21 on the deal side. And by dollar volume, the investment activity for that, it's at about 2.4 billion. So it's a very active category. It includes home buying platforms and mortgage and closing platforms, which we're going to talk a little bit more about, are two of the most active. But just to kind of summarize here, the mix of the funding stages has shifted. So from mid to late stage rounds, it's up 235% so far in 21 versus 2020, while the seed and early stage that you'll see here in the darker blue color is up 124%. So that you'll see that shift happening over time. From an M&A activity, kind of just pure deals, you'll see here kind of annual records starting in 2021 at 132 deals for first half of 21. It's been a very acquisitive, obviously, first half of the year, greater numbers than we've seen in any other year. Also, more of the private players aiming to kind of increase and scale their businesses by accelerating through acquisitions. So it's been very busy year for all of us, but very from an M&A activity kind of just record setting. SPACs we covered, but they remain active as Sophia mentioned. There's quite a few transactions that we could call out here that you probably would be very aware of, like Matterport, which is kind of a photography VR type of software package. We just mentioned SmartRent, which you'll see towards the bottom of the screen. But I'd say overall, SPACs have been a big part of the story for PropTech, and as we mentioned earlier, they've made it much easier for folks to access the capital. It's kind of dozens of SPACs have consummated, been announced, or focused on PropTech. You'll see here on the right side of the screen, almost $40 billion in value. So the focus continues. We haven't seen any major underperforming, kind of SPACs yet, but it's too early to tell. But it has been a very successful kind of way to access capital for many startups. So we have I'm going to take a few questions here and pause for a minute. How does a company go from Series A to B to C? That's really dependent. Well, Sophia, why don't you jump in on that one? I think that you would be
Sure.
best at that.
Sure. So when a company, starts out, they look to money to build their product. And by the way, all of this is super fluid. So there's no, accepted definition of what's pre-seed, seed, A, B. Every company hits its own milestones depending on, what works for the founder, what they're building, how much money they need to build what they build, or what they want to go and build, and traction and so on. But as, at a high level, companies start with a pre-seed round, and that's, call it $500K, $1 million, something like that, to go out and build an MVP of product, so minimum viable product. What is the least amount that they could build to start proving product market fit, like that people actually want to buy what they want to go build. So go prove that out. Once that's proven out, sometimes by a little bit of traction, they'll go ahead and raise a subsequent round. They'll raise more money and at hopefully a higher valuation. Not always the case, but usually if things are trending in the right direction. And then they'll use that money, call it seed round. I don't know. Again, it totally differs, but call it a few $1,000,000. And hopefully they hit their target numbers. So investors will look at, revenue growth, for instance, or customer growth, or net revenue retention, meaning if I have customer A and they spent $10 on me last year, are they spending 12 or more dollars on me this year, or did they churn? So things like that are markers to say, hey, like what they've built is actually working. And if that's the case, if revenue is trending in the right direction, if you started with 10 customers and then after the seed, you now have 15 customers, et cetera, then they'll usually be able to raise a subsequent round. So all of that's to say that it's super fluid, but founders will usually, set out targets that they say, I want to raise this amount of money to get here. And if they're somewhere around there or close to tracking to what they said they would, investors will get excited about backing them again and at a higher valuation, because the more revenue a company has, the more de-risked it is, because people actually like what they're selling. Hopefully that answered your question, but if you have any others, feel free to chime in.
And I would just say that that we're seeing today more than ever that basic kind of channel from, used to be, say, going A to C or D might take you 2, 3, 4, 5 years. That the acceleration in all the capital that we're seeing in the market has really narrowed that timeline down to 18 to 24 months. So you're seeing many of these startups go from seed to A, B, C much quicker today than they ever have.
Yeah, and Maureen, that's actually a really good point. And Megan, you'll keep me honest here. Megan and I share a portfolio company called OpenSpace, which I'll chime in about here because that's a perfect example of what you just mentioned, Maureen. So OpenSpace raised a $55 million Series C earlier this year, and that's only less than a year after raising a $16 million Series B last summer. So within a year, they went from raising 16 to 55 million and upping their valuation pretty exceptionally, all due to really rapid growth and adoption. So they've raised over, or I think right around $90 million in under 4 years since its inception. I'll double click on what OpenSpace is for anyone interested as well. So it's computer vision technology for construction sites. I like to say like Google Street View for construction sites, for anyone familiar with Google Street View. So the platform enables virtual inspections, bid walks, safety checks, sub-coordination, and ultimately creates a system of record of what actually happened on a site during construction and development. At a high level, the goal is to help developers and GCs who are their customers to deliver buildings on time and under budget. Eventually, OpenSpace will sell to other stakeholders. It'll help insurers reduce claims and better price risk, and ultimately lenders, which actually started using the product already as a result of COVID, because they can now see what's going on the site from the comfort of their homes. They don't have to actually go in. So that enables more streamlined construction loan distributions, and just limits the amount of stakeholders on site, which in a post-COVID world is obviously something that was really attractive to customers. So tons of customers of OpenSpace, a lot of recognizable names: AECOM, Brookfield, DPR, Skyline Construction, Suffolk, Swinnerton, Turner, Tishman Speyer. The list kind of goes on, and that's kind of why they've been able to continuously raise so quickly. Megan, feel free to fill in if I missed anything.
No, I think you covered it. I was just going to say real quick about the going from Series A to Series B. Can they make the case, and can they show why they want to raise the money? That's really what it comes down to. I mean, it's there's no cut and dry. There's no rule necessarily. Is an investor comfortable putting money in at the valuation at the time? And if they are, it could be, they may not have grown, they may have lost customers, but they see the potential in the company and they say, now's the time. So there's no rule. Obviously, different VCs have rules on when they spend money and so on and so forth. But as it relates to open space, I was just going to add that they're one of our most successful portfolio companies to date. And when I say successful, I mean the JLL fit is there. Our project managers in our basically construction group called Project and Development Services, PDS, they're using the open space cameras. They're actually walking the sites every day, and they're they're sparking joy for customers. They are improving their service delivery model. They're allowing their customers, sometimes the customer could be the GC, sometimes it could be the client directly. They don't have to go to the site. They used to have to travel, every other week, and that could be out of state. They no longer have to do that. So it's a huge win for us because our project managers are so happy. They don't have to be there as often. The clients don't have to be there as often. It's been a massive win for us. And I think you'll see more of that in the future with other firms like JLL. So we're really excited about open space.
Thanks, guys. Second question, I'll just, the deck can be shared, yes, and we are recording the session. So you'll be able to access both following the session. So we're going to jump in next into, how PropTech has accelerated due to COVID. I think Faisal actually mentioned it in his intro remarks, but McKinsey actually has assessed it and feels that that we've accelerated by 5 years forward in digital adoption in a matter of 8 weeks. That's probably the most extreme I've seen, but as Faisal mentioned, 7 years for global, 6 years for North America. They're all big numbers, right? It's been a crazy 18 months, and we've certainly captured a lot of value along the way, and in the number of companies that have entered public markets, and I think everyone understands that it's been a net accelerator, COVID, of PropTech. When we think about it, from a Metaprop perspective here, we look at this kind of 2 by 2 as a way to look at technologies in the different categories. One being already in motion and now was accelerated by COVID. 2 being it had limited prior activity and is now activated due to COVID. And then 3 being previously in motion and now under pressure. So you'll see within each, and this was done, at the beginning of COVID. So it changes daily. So to keep it current, we would be editing this almost daily. So you'll see here, from a in motion perspective, all things from a COVID perspective around, getting, back to work and getting folks comfortable in safety and security within, kind of an office setting, and all things tech related around that, whether it's, you'll see here, some of the HVAC and environmental quality, air quality, the occupancy usage and monitoring, touch-free interaction is at the top of the list. How you access and exit, spaces. How do you monitor, how many folks are in the space at any one time? So robotic cleaning, thermal scanning, and contact tracing early on were very big around, kind of accelerating that area for obvious reasons. Then on the flip side, where we saw the co-working and co-living at the beginning of COVID, really take the decline, and as well as kind of some of the brokerage technologies. So you'll see here, what we wanted to do really was to help you think about kind of the different things that have happened around COVID, and then jump in on this next slide to really some of the notable themes that we've seen, and really go deep on them with you, so that we could spend some time talking about some of the questions you had asked. So I might, on this slide, really jump into with Sophie and Megan and talk about a little bit about emerging technologies in CRE and what you all are seeing, and then maybe a second question around. But let's start with actually the investment thesis. Has it changed post-COVID? How are you guys feeling about that? And maybe each of you could just touch on it a bit.
I can start. Spark's investment thesis has not changed overall. We already knew these things were going to happen, obviously not COVID. We knew that we were moving towards a more hybrid work experience, for instance. That has been accelerated, and it's happening now. We knew it would happen in the next 10 years. We already saw our clients doing it. So we knew it was inevitable. COVID accelerated it. I think the things that have changed, there is, and this is part of the benefit of working for a CVC, is the feedback we get from clients. I hear constantly, do you have anything on smart cleaning? Do you have anything in smart cleaning? How do we know quality control of the cleaning? Usage-based cleaning. And some of our portfolio companies are doing that or have pivoted to be able to do that. So a VergeSense now can use the same ceiling-based sensors they're already using to identify areas that have not been occupied and send cleaners in the direction of places that have been occupied all day, for instance. Infogrid is another company that aggregates sensor data that we've invested in, and they've come up with a smart cleaning solution. So there's a lot of excitement around smart cleaning. And I think we all realize now, like, we would like our environments to be cleaner anyways. So COVID has really just like reminded us of how much we touch and how dirty everything we come into contact is. We are also looking for technologies that reduce the risk of contagion. So anything touchless, keyless entry, that kind of thing. And then finally, improving remote collaboration. And I don't think that there's a solution there. We have not seen it, at least. I don't know, Sophia, if you've seen it, but figuring out how to bridge the gap between the physical work environment and the digital experience you have working from wherever you are. And I think we all know, and I work for JLL, and I can tell you it's not necessarily seamless all the time. So that's an area that we're actively kind of investigating and hearing from clients about. So those are some themes and some focus areas for us moving forward. But again, long-term strategy is still somewhat the same.
Thanks, Megan. Sophia?
Yeah, so I'd say mostly our strategy is the same, but a little bit different, and I'll touch on one of those reasons why. So Maureen, if you go back to the slide prior, if you see on the top left, you see co-working, co-living, alternative accommodation. So all of those fall under the category of master leases. So using a master lease model, operators will lock in base rents, which they pay to landlords, and then they sublease those apartments or spaces to renters at a premium. So basically the idea is that these startups increase density and or improve operational efficiency, create rent, lift or arbitrage, which is the difference between what they pay to landlords and what renters pay them. So seemingly like that worked pretty well. You're probably all familiar with WeWork, I guess is the big name there, at least in co-working. And then obviously COVID hit. And what happened there is suddenly operators ran out of lift because they were on the hook for all of these rents that they owed their landlords, but they couldn't actually sell them to customers. And at the end of the day, many of these startups struggled to keep up with costs, and eventually many of them went out of business. So all that is to say is that that's a super capital intensive, low margin, non-recurring business model. So we kind of thought to ourselves, what's kind of accelerated here? And if you look on the top right, a lot of that you'll see different software solutions. So we at 9-4, we believe that the companies best positioned to succeed are those leveraging higher margin, lower capital intense models, selling through into stakeholders and offering cost optimization technologies by whether it's by increasing operational efficiencies or increasing productivity or throughput, or there are a bunch of ways to do that. But I guess that's a long-winded way of saying we're focusing a little bit more on software models and a little bit less on like higher capital intensive PropCo models.
Awesome, thank you. So from a themes perspective, just to go a little deeper, so everything, return to work tech is pretty much on everyone's list, and we're seeing some call outs there. data from the perspective of, COVID, everyone, kind of from an LP perspective is very interested in how to get their behavioral data, their sensor data, and their property data, and get it into a place where they can use it effectively to make decisions. And so we're seeing a lot around that. Of course, carbon tech, everything, all things sustainability are, big in the world right now, including especially a big push towards energy management, and all things tech related to that. I think that, we certainly are, kind of deep in the construction tech that was accelerated by COVID for obvious reasons. We, had a lot of construction going on at the time, and getting people back in to complete those projects was particularly important. All things customer and user experience, as Faisal mentioned at the beginning, the employees and empowering employees and making employees comfortable, whether it's the user or your customers, and getting them on a journey that's seamless, has been two big focuses this year. And then lastly, as we mentioned earlier, fintech has been a big push, and has been probably has seen the largest growth over the last year. I'll open it up here. I think maybe Sophia, you want to touch on a couple of your portfolio companies. I think you
Sure.
hit a couple of them already, but maybe in the construction tech or fintech.
Sure. I'll touch on one and then leave time for anyone who has questions. So if you see on the bottom in the fintech, you'll see Bowery there. So Bowery Valuation is actually a company we share with Metaprop. So it's a portfolio company of both of ours. So it's a vertically integrated commercial appraisal firm. So what that means is the founders, they built proprietary cloud native software to then power their business. So they actually do still hire commercial real estate appraisers. But the difference here is they built technology around them to automate tasks. So think like comps, photos, zoning guidelines, everything they need to make them more productive. And that way each appraiser can do the work of three traditional appraisers. That obviously increases margins, and they can give some of that back to their customers, enabling faster, cheaper, and better ultimately appraisals at the end of the day. So as you can imagine, during COVID, this business got hit. There were fewer transactions happening, and fewer transactions means fewer appraisals. However, what was interesting was that even though there were fewer transactions, their customer numbers swiftly went up. And that was because the people who actually were transacting now wanted a digital and also a cheaper alternative. And in comes Bowery with, to the rescue. So as soon as transaction numbers came back up, Bowery's revenue numbers jumped, and they actually subsequently just raised a pretty meaningful Series B from Goldman Sachs, and have since been doing pretty well. So that's an example of like how COVID affected both negatively and positively on a business.
Thanks, Sophia. So we'll open it up here in the remaining kind of 7-8 minutes that we have for questions. You can either enter them in the chat, or I think they can open it up for you to actually ask the question. Not certain about that, but at least you can enter any of them in the chat. And while you're thinking about that, the one question from the list that we were given that was most interesting to you all was, kind of what prop tech technologies are most interesting today for occupiers, and why we're thinking through that, and we'll all kind of weigh in. I would say we're seeing, definitely, as we mentioned, the occupiers as tenants at least are definitely have the advantage of having access to all kinds of technologies to manage space and their occupancy that they, that didn't exist prior to COVID, and that is continuing to accelerate. Whether it's, managing your employees through all of the HR tech that's out there now, or who's in the office, or who's working remotely, or kind of how much, where you'd like them to sit, and how do you space the office, you use that space appropriately, to the actual lease, your actual leases, right? And someone like occupier.com, which we invested in this year, that basically helps you with your lease administration, and helps you understand when what's within your lease, and when specific pieces of the terms are going to be expiring. And so there are all kinds of technologies out there now for occupiers that didn't exist before, and that have accelerated quite a bit due to COVID. I'll pause for a moment as we got a couple of questions here. PropTech each tackle one-off problems, interested in your perspective that as occupiers think about this, how can we manage a suite of applications and integration of intelligence?
I can comment on that.
Sure.
I don't think there is an answer, but Spark, and I think we're hearing this from clients, but there's a massive appetite for integrated solutions versus these point solutions that are for discrete problems. So to give you an example, SaltMine, I know Brigitte is on this call. The workplace data is very fragmented. SaltMine's created a platform to be able to view all of this data in one place with multiple stakeholders and multiple data sources. So that's a good example of an investment we made that we're excited about it because it does aggregate all those things together. OpenSpace is similar in that it brings all of these stakeholders from a project onto one platform where they can all view a project, see how it's going, blah, blah, blah. So I think there's going to be a massive amount of consolidation moving forward, and no real player has stepped up at this point because there are so many discrete solutions. But I think there's a huge need.
Yeah, and I would say too, just to add to that, Megan, that the enterprise providers we're seeing more today, they're stepping up as well. So you kind of have the old traditional enterprise providers like the Siemens and others like that, and Johnson Controls and others like them in the world, where they're actually moving quickly to kind of expand their offerings to compete with the startups. And so it will be interesting to watch. I'll let you weigh in, Sophia, if there's anything you'd like to add before we go to the next question.
No, I think you guys covered it. So
Maureen, I'll add that JLL is building for the same problem as well. They just recently launched Azara, which is a BI tool that would aggregate all the data at the building level. So everyone's, I think, competing to get there because that is the massive opportunity. And I don't even know if a startup could handle that big of an opportunity. It's that big, and it's that big of a problem.
Well, the issue is it's a matter of sharing data, right? So it's like all of the landlords sharing their data, or all the brokerage firms sharing their data. At some point, we'll have to get to a place where all of the data is consolidated so that it can be truly effective. But I think we're a long ways from there.
In the meantime, the startups are integrating with each other, though. VergeSense integrates with SaltMine. VergeSense integrates with Infogrid. Disruptive Technologies integrates with Infogrid. We're seeing a ton of partnerships being formed, even within our portfolio company family, but I'm sure outside of us as well. So,
for sure. So let's jump into cybersecurity. It is definitely a huge problem, and one that we're seeing more and more PropTech, engagement, but one that's, still, we're not seeing yet in North America as much as we have seen the shifts in the PropTech in Asia and Europe. But I do see that it is expanding, and I'm trying to think. Nothing yet in our portfolio as it relates to cybersecurity. I'm not sure on either Megan or Sophia if you have seen anything on your end.
I've seen a couple companies, nothing we've invested in yet, focused on cybersecurity, specifically within IoT. So like connected home devices, if those get hacked, obviously it's a big problem if people who aren't supposed to open your lock can open your lock. There are different technical ways that companies like SmartRent, for instance, have gotten around that. For instance, using like a cell service provider versus its own hosting network. And then, to be honest, it gets pretty technical from there. So I'm not going to attempt to answer exactly how it's done. But we've seen a few companies in that space, but less of a big of a big space that we've seen a lot of companies in.
Okay, thank you. So
I'm
next,
happy to answer Lindsay's question next as well, quickly, if that's helpful.
yeah, I'll jump in. I'll start with the early stage piece and then sure jump in. I would say from early stage startups, the things that we're seeing that I think are most, well, first of all, I think that there's very few things that weren't started prior to COVID, right? That we had quite a bit of traction rolling into COVID. You know, I do believe that the things that are that have gotten most traction, to your question, that might not have had as much pre-COVID would have been, you know, more around, you know, sustainability, which, you know, it's had its own track due to the change in you know, our presidency. And then two would be for me more around data. I think that there was a big push, and it's very exciting to see what's happening as it relates to digital twins and the whole concept of twinning a building and being able to operate it remotely. So those would be my view on the early stage. Sophia?
Yeah, what I would say I think is super interesting is that COVID acted as a forcing function for traditional stakeholders to look to and adopt technology. So companies, you know, quote unquote startups are competing with huge incumbents. So just to name a few, on the insurance side, we now have Hippo that actually recently went public, which is a digitally native direct homeowners insurance carrier that's competing with the likes of, you know, State Farm and Liberty Mutual and these nationwide, these really big names. And I think the reason for that is because COVID exposed a gap and people wanted cheaper alternatives. So they were more likely to go to, you know, a lesser known brand name startup just because it's cheaper. So things like Hippo have inflected, you know, and as people rushed out of cities into the suburbs during COVID, and mortgage volumes steadily increased, there was a bunch of software that capitalized on that. I'm sure a lot of you have heard of Better Mortgage, which is a tech-enabled digital mortgage lender, and they were competing against the likes of, you know, really big name banks and have seen some nice market share there as well. So for me, what's exciting is the fact that these startups and digitally native companies are showing that they can compete with the big guys.
Hey, thanks, Sophia. So I think we're up on our hour. I wanted just to say thank you to both Sophia and Megan for joining me, and Faisal for organizing all of the entire you know, kind of panel here today. And then lastly, thank you to all of you for participating. If there's anything, please, you know, any additional questions we didn't answer, please reach out to us individually, and you'll also be able to, you know, download the presentation and the recording from CoreNet. Thanks all. Have a great day.
Thank you, Maureen. Thank you,
Thanks,
Sophie.
everyone.
Megan.
Thank you. Yeah.
Bye.